Well, hello, everyone. I'm Joe Duarte, author of Trading Options for Dummies and Everything Investing in Your 20s and 30s books. Welcome to Trading at the Edge of Chaos, where I live. And this is StockCharts TV Options 101, how to let your stock charts lead you to great covered calls. You want to know more about what I do, take that free 30-day trial subscription to my website, Joe Duarte in themoneyoptions.com. Make sure you put in Joe Duarte in themoneyoptions.com so you go to the right place. Let's get started on how to let your stock charts lead you to great covered calls. So first thing I want to do is talk about the goals of this presentation. Obviously, we're going to talk about some option definitions. This is Options 101. We're going to talk about the charting characteristics for options and also covered call option strategy. That's what I really want to focus on today because it's a great way to produce income, especially when you're just getting started. And certainly we want to improve the trading results by using this knowledge that we gained today actively. Let's get started. Always start my talks with sound trading principles. Don't fight the Fed. Don't fight the market's momentum and dominant on the ground trends. Look around and see what's working, see what people are buying. That kind of gets you in the right frame of mind. Then you find a great chart. And of course, that takes you the rest of the way. You want to stick with those strong sectors and stocks. You trade in those small lots. That means if you're trading stocks, 100, 200 shares, don't go too much above that unless you have a lot of money. And in options, 1 or 2 contracts is probably fine because volatility will take your money away in a hurry if you trade more than that. If you got profits in stocks, take 20%, take the profits at 20%. Options a little bit different, but certainly if you've got a 20 to 50% gainer in options, you might want to cut that position from 2 contracts to 1. In stocks, sell stocks no more than 5 to 8%. Options, a little bit different. I like to use dollars as my sell stops. I don't like to lose any more than $25 to $50 per contract, if that much. As usual, you monitor those lagging sectors for potential turnaround candidates. That's where the new winners may come from, and manage that cash wisely. Don't be in a hurry to put it right back in. Always look for the right place to put your money. Let's look at some general option facts. Options are derivative securities. That means that the price of the option is at least partially based on the price of the underlying stock. Makes sense. Apple options are based on the price of Apple stock. So here's the other things. Options prices are based, as I said, on the underlying security, but also on options pricing models. And these are equations that are way too complicated for most of us, but certainly they are used to create that option price. And of course, supply and demand. You can have a great option, an underlying stock, and nobody buys that option, then it's going to go nowhere. So always remember that options are designed for risk management. I know that people like to buy call options and hope that they double and triple in a couple of days. They're really designed for risk management to be used best with underlying stocks to protect that entire position. They are created on demand. So when you put in your order to buy a call option, the market maker, which is usually a robot, will create that option unless there's someone who wants to sell it to you. And of course, they offer the ability to trade that underlying stock with less risk. You got a $150 stock and you buy 100 shares, it's $15,000. If you buy an option for $5, that's $500. Not a hard thing to figure out that options let you participate in the general trend of the underlying stock for less money. And so that we don't continue to look like this guy over here on the right, let's look at a couple other things here. Option rights and obligations. When you buy an option, you have the right to sell that option at the strike price, which is the price that when you buy a $40 call option, that's the strike price, $40. Selling options gives you obligations, which means that someone may want to take that stock away from you, and you have to. And don't worry, your broker will do it if you get assigned. So again, risk management, created on demand, and less risk and less money involved in trading options. So more basics, calls rise in price when the underlying rises. Generally, you buy those calls when you're bullish. You puts rise in price when the underlying falls. You buy puts when you're bearish. Selling options produces income. You sell calls when you're bullish about a stock, but the stock isn't rising. You get premium. You sell puts when the stock has limited downside. I personally do not like selling puts. That creates a very risky position. But if you research how to do that and you want to do it, please get my book. It tells you how to do it, and you can certainly try it, but I'd rather not in my own account. So here's the big thing about options. When you get into options trading, the clock is ticking. You have to make that decision about reversing that call or that put, or buying it back or selling it by the expiration date and by that certain strike price, depending on where you are. So you have to rely on the price direction of the underlying at time to expiration. It could be 60 days, 90 days, 3 days, whatever. And certainly you want to have those options, you want to trade those options that have liquidity. If an options contract isn't trading, at least 50, 100 contracts per day, you probably don't want to be messing around with it, because the spread, that's the price between the bid and the ask, is too high. The market maker just cleans you out. So liquidity, supply and demand. And remember, the clock is ticking. A few more things: strike price, the price that determines whether an option is in the money or out of the money. Of course, $40 is strike price. At $41, your option is in the money. At $39, it's out of the money. At $40, it's at the money. The delta is called a Greek. It's basically a part of the options pricing model. It's a change in the options price for every dollar change in the underlying. Gamma is a change in the delta per dollar change in the underlying. And of course, options have time value and intrinsic value. And intrinsic value is a component of the options price once the option is in the money. So at $41, your $5 option may be worth $5.25. Time value, the component of the price based on time left to expiration. You get to that 30-day or less expiration, that time value starts to evaporate quickly. So make sure you understand that concept. And again, reviewing here, XYZ with a price of 40, as a strike price of 40 is trading at 41, it's in the money, and so forth. And again, if the XYZ option, $40 option, is valued at $3, it may have $2 of time value and $1 of intrinsic value. So let's forget about this guy over here, because now we know everything we need to know. And now we can start with stock charts and how they lead you to make good buy right or covered call trades. So I always like to start with the New York Stock Exchange advanced decline line. That's because this gives me the cleanest picture of the trend in the stock market. The algos, the market makers, and the big money guys that like to mess around with indexes through crazy option trades and spoofing and all the things we hear about in the day trading world. Hard to do here, because this is basically how many stocks advance minus how many stocks decline. So you get a very clear picture of whether you're in an uptrend or a downtrend. So if this is a bullish picture, you want to concentrate on calls, such as we had for the long term. And currently, we're in a bullish picture. This is a little bit of a dated chart where we have new high and the advanced decline line made today, and that's April 9th, and that's certainly a bullish sign. So if it's bearish, as it was during this period here, then you want to concentrate on buying puts. Other things to remember about the advanced decline line: as long as it's above the 50-day moving average, this blue line, 200-day moving average, this red line, you're in the what I call the complexity zone. Don't worry about that. That's actually bullish. If it's below the 50-day or below the 200-day or both, you're in the chaos zone. That means things are bad. Last thing about the advanced decline line: a fall below the 50-day moving average at the same time that the RSI falls below 50 can be a very bad thing, because that could lead to more selling. So advanced decline line is your first chart for every trade, because you want to make sure that you're on the right side of the market. So options are all about volatility. Okay, and there's two kinds of volatility. There's historical volatility, and then there's implied volatility. Historical volatility on StockCharts.com is depicted very nicely by an indicator called standard deviation, or SD. Historical volatility is related to the price of the stock. Meanwhile, implied volatility is related to the future price of the option. So while historical volatility tells you what the stock has done in the past, implied volatility tells you what the option is likely to do in the future. So here's what's really important. When you compare the implied volatility to the historical volatility, it helps you to make a decision about whether to buy an option or sell an option. Generally, when you have a high implied volatility in comparison to historical volatility, you look to sell options. And when you have a low implied volatility in comparison to the historical volatility, you look to buy options. Okay, so real quick here, this is a chart of Agilent Technologies, and I chose it because it's a low historical volatility stock. Okay, and you can see here that the SD is anywhere from 0 to 4. Okay, you can see the stock trades fairly orderly fashion most of the time. Had some difficulty once in a while. Most of the time, when it trends nicely. So if you were thinking of buying an option here, you'd look at the implied volatility. If it's somewhere below the historical standard, which is, for all intents and purposes around 3, you might want to buy that option. And if the implied volatility shoots up to 10 or 12 or something along those lines, just for illustrative purposes, you may want to sell an option. So historical volatility, implied volatility. Now, let's look at a high historical volatility stock. Again, historical volatility has to do with the stock price, implied volatility has to do with the option price. So this is Tesla, okay? And if you remember, Agilent Technologies was a nice low volatility, historical volatility stock. Tesla is a high historical volatility stock or high HV stock. You see that anywhere from 0 to 70. Big difference, 0 to 4, 0 to 70. Tesla goes up and down like a yo-yo, and so it has a high historical volatility. So you can be fooled here because you can say, well, if the implied volatility for Tesla is 65, that's high compared to Agilent. Well, you'd be correct, except for Tesla, 70, is not necessarily that high. So, because you can see it somewhere here, 40 to 50 is where the average historical volatility is. So if you were going to sell a Tesla option, you'd really want it to be above that 70 area. And if you're going to buy it, well, right now might be an interesting time to buy a Tesla call option based specifically only on implied volatility. So the take-home message is high implied volatility, look to sell, low implied volatility, look to buy. But it's a comparison of the implied volatility to the historical volatility that you're trying to make. So I want to put this all together in a trade that I made recently and that I recommended to my subscribers at Duarte and themoneyoptions.com. This is Academy Sports and Outdoors, a sporting goods company that went public in October of 2020. Okay, and if you've read the news recently, there's been some volatility in the stock for unknown reasons. Big block of stock was traded after hours yesterday and all kinds of things. I'm not really focusing on that because that's not what was going on along the trade. Okay. The reason I put this trade on is as follows. Number one, I bought Academy, and so did my subscribers, somewhere down here in November. Made all this money all the way up here, and then the stock just basically stalled. At the same time, okay, the stock would not break down. So the first thing to note here is that the stock in a long trading range that is not breaking down may be an excellent candidate to sell a call. In other words, you're selling a call in order to pay yourself for waiting for the stock to break out or break down. Okay, so first thing. Next thing you want to look at is this stock being accumulated or not? All right, so you look at accumulation distribution here. As this thing started stalling out, then we see that accumulation distribution was breaking down. In fact, if you did further research, you would have known that Academy was actually very highly shorted stock. So this is a sign of the stock being shorted all the way through here. Okay. At the same time, on balance volume was actually pretty steady and looking pretty Good. So short selling was not driving the price of the stock down. In fact, you could see it as creating a potential bullish situation in the future because the shorts were not able to crush the stock. That meant that the buyers that you saw down here were actually likely to gain the upper hand under the right conditions. The right conditions can often be an earnings report. So somewhere over here on March 30th, the company was due to report earnings. So I sold a call at the same time that I bought an extra 100 share of stocks. I still kept my position, but I bought more stock and I sold call options. Okay. So the basis for my trade is also known as the break even, and I'll give you the details in a second. Okay. The price of the stock, which is the price of the stock minus the premium received for selling the call. So review again, stock that is moving sideways. You can see the Bollinger Bands are constricting. You can see the short sellers are trying to hammer it. You can see the buyers are coming in, and you can see that an earnings report is coming on March 30th, and that means the stock has the potential to move in a big way. Now, what was the key to the whole thing? Okay, the historical volatility was 35 at the time, and the implied volatility was 85. So that told me that if this company actually developed or delivered a positive surprise, the stock was likely to pop. Okay, again, Bollinger Bands are shrinking. That means a big move is coming. Accumulation distributions falling, short sellers trying to hammer it, not working because unbalanced volume is telling you that people are coming in at the same time. The RSI was near 50, but not below 50. And lo and behold, right here, okay, the ROC went to -10. That tells you the stock was exceedingly oversold, which meant that a positive surprise would likely lead to a big move up. Moreover, the stock was above 20 on the 50-day moving average. I want you to frame all this, okay? Also, you can see that the volume by price over here, a lot of sellers right in this general price area here, but a lot of buyers came in, okay? That confirms all this that you see when the stock delivered. Guess what? A better than expected earnings report, so the stock shot up, okay? Now, again, what you do is you buy 100 shares of stock, you simultaneously sell a call option, break even, and so on and so forth. So here's how the trade worked out. So you buy 100 shares of Academy Sports and Outdoors on $329.21, and you bought it for $25. You simultaneously sold to open an ASO April 16, 21, $30 call option. Big reasons for that, okay? April 16, it's only 16 days, okay? 16 days to expiration. That means well within that 30-day or 45-day period. That means you're not going to have that high of risk. Okay, that implied volatility made the price of that option be nice. So you got $100. You got $100 premium for owning a stock potentially for 16 days. Okay, and I did something a little bit different, which is slightly outside the scope of this conversation, but I did a collar trade, which means I bought a put at the same time as I sold the call because I wanted to protect myself in case I was wrong and the price of the stock collapsed on a bad earnings report. You just never know the way these things are going to work out. The put only cost me $35. So by the time it was all said and done, the basis for my trade was $2,435. Okay, and the stock popped right here, and then it sort of popped the next day. And the more it wanted to pop, I decided that I wasn't really wanting to give up that stock because if it goes high enough, you're going to get assigned, okay, close to that strike price. So I closed out the trade. I bought the option back for 60 cents, and that means I made $40 on the trade. I also sold the shares for $27. Remember, I bought at $25, so I made $200. My put went to zero because the stock popped up. That's okay. I lost $35. I didn't mind. So the return for this trade was $125 in 2 days. Okay. Now, this is about as good a buy right trade as you're going to be able to make. I'm not necessarily speaking on the amount of money you can make. I'm speaking about the way it worked out. You have the right stock, the right time, with the right technical information, the right price for the option to be sold. You had a very inexpensive put to buy in order to call it. So this is what you want to remember. These are the conditions that you want to look for every time you sell a call. So let's put it all together. Options are risk management tools, as you saw in that trade. I managed my risk at a potentially dangerous time when a stock that I owned could have crashed because of a bad earnings report. Remember that calls are for uptrends, so you can buy them or sell them depending on your on the trend or what you're trying to do with your risk management. Puts are for downtrends. They can also be insurance. You can combine stock and options, both calls and puts, to put together a strategy that makes money, but at the same time protects you. You also want to be able to use volatility and price charts as guides to your strategies. That's all I have for today. I want to thank you very much for your time. I'm Joe Duarte, Joe Duarte and themoneyoptions.com. If you want to know more about options, get trading options for dummies, you can buy it at the StockCharts bookstore or Amazon.com. Have a great day, and we'll talk again.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.